Hi and welcome to On the Record, your playbook for tapping India. Today we will look at if you are trying to flip your HQ from India to US, how you should be going about it. So the first and foremost thing is the planning phase. In this, you should first identify the complexities and challenges as to how the whole process will work. Then you should also identify and look at your cap table. What does your cap table consist of? How many investors, stakeholders, employees who are sitting on the cap table, because you'll have to clean up your cap table. Then you should also look at valuating your Indian company, that is all the IP, assets, whatever you have. So you have to have a formal valuation report. So you should value the Indian company. Then you should also estimate the amount of taxes that would be applicable either during the process or after completion of the process. So there can be capital gains tax, there can be income tax and any other kind of taxes and levies that is applicable. You should also identify about the FEMA laws and other challenges, like what are the timelines and cost to do all these things. So these are the things that you should plan before you should start executing. Now let's look at what are the options that you can evaluate when trying to flip your company from India to US. There are broadly three options which is available today. One is the corporate route, the second one is the parallel structure, and the third one is the EOR structure. Now let's look at what is corporate structure. So in a corporate structure, the founders, typically two or more, each float an LLP individually in India. So they don't float an LLP with each other. So they probably with any other of your relatives or a family member, you can float individual LLPs by each of the founder. Now this LLP goes ahead and incorporates the US company. So technically the US company shares are held by these LLPs, not by the founders directly. Now once the company is incorporated in US, then you should clean up the cap table in India. That means whoever is sitting in your cap table, you have to mirror the cap table in US so that before you raise the next round of money, whatever your Indian cap table looked like, it also be mirrored at the US level. Now how do you go about mirroring the cap table? Mirroring is the same thing, it's just that how will you transfer the money or how do you issue shares without much transfer of money. So this is not a very straightforward answer. You should work with an expert to look at the exact scenario, what does the cap table looks like and how are the ways it can be mirrored. Some are the ways like you can just have a virtual mirroring, like having a phantom stocks blocked individually and then saying that okay, whenever there is an exit option available, we'll use this pool to give exit to whoever is the linked stockholder or the shareholder. So once the cap table is mirrored, you should go ahead and raise your money in the HQ. So you can go ahead and raise whatever investment round you're planning to raise. After that, you can start incorporating company in India as a subsidiary, or if you have an existing company, then you can sell all the shares of the Indian company to the US company. Now, before you do that, you have to clean up the cap table at India. Otherwise, if an investor or any other founder is sitting on the cap table in India, then technically whatever is the valuation of the Indian company, the money comes in, that money will go to all the founders and even investors, employees and everyone, and that's kind of getting as an exit for them. And you are not here to give an exit right here, because that includes capital gains and also that's not the motive of the structure. So you should first clean up either through a buyback or through some other structure. Again, you should take an expert help in identifying how does the cap table cleanup will work. Or the better way is, if you are not able to clean up the cap table, you can actually, instead of giving an exit to the existing shareholders, you can even look at injecting fresh amount of capital. Parent company will also sit as an additional shareholder in the cap table, but they will hold the majority share so that it becomes a subsidiary of the parent company. After this, once the parent company is structured, then you have to formally assign all the IP rights and other assets to the HQ, because from this point onwards the HQ should be controlling all your IPs and other assets. So whatever money is required based on the valuation, again you have to bring the money to India either as a cap table or through IP sale. Now that's where again a tax would be applicable, either a capital gains or a income tax. So you should budget for that. Once this process is done, then you should go ahead and do all the compliances which is applicable, either the FEMA compliances and or any other compliances that is needed both in India and US. And after that you have to pay all the applicable taxes, whichever is applicable, either during the transaction or post transaction. You should pay all the taxes and then the transaction would be complete. So that's broadly about, if you are trying to flip using a corporate structure, these are the steps that would go in. Now let's look at how does a parallel structure looks like. So a parallel structure is essentially the founders incorporate an HQ in US and they keep running the Indian entity as an independent entity. There is no ownership connection between the India and US entity. So US entity becomes the parent. So basically the founders go ahead and incorporate the US entity. After that, again they have to mirror the cap table. Based on whatever was the cap table in India, you should mirror it. Then you can go ahead and raise the money in US. You should also start assigning all the IPs and stuff, since there is no money coming in as capital here. So you have to do the IPR sale here. And again, an income tax and stuff would be applicable based on the valuation of the company. After that, you can enter into a master services agreement which will identify India as a vendor, which would continue to offer all the services, like the India company and all its employees would continue to offer services to the US company and build IP going forward from the date of IP assignment. So once the master services agreement is executed, you should also start cleaning up the cap table in India. Since you have already mirrored the cap table at US for the existing investors and founders, you should clean it up, because otherwise whenever the Indian company is closed or sold, then again the cap table structure might become a challenge. So you should figure out and work with an expert to see how to clean up your cap table. Depending on your scenario, there are various methods that you can look at. So choose the one that is best suited and most tax friendly kind of thing. After that, you have to go ahead and pay all the applicable taxes that has happened during the transaction. For example, income tax would be majorly applicable in this scenario. So you should go ahead and pay taxes on that. After all this is done, then you should start complying with the FEMA and other laws which is required to do all this stuff both in India and US. So while you are doing this, you should also remember two important things. One, the Indian company can never be a subsidiary of US company, not just today but also in the future, and that's because, at least as per the laws which is governing who can form a subsidiary in India. So since the founders are in India and they are holding shares directly of the US company, that company can never form a Indian subsidiary, at least as per the current laws. If there is any change in laws, then you'll have to evaluate it accordingly. The second thing that you should be looking at is, even if this is two independent entities, but since this is a related party transaction, like the founders are holding the Indian entity and the US entity, all the transactions are eligible for transfer pricing. Now we'll cover transfer pricing in detail in another video, but you should know that India will continue to get a markup on which you will end up paying a corporate tax, and it will never be under losses. But after paying taxes also, you will be left with some surplus cash, which can only be used for capex purposes, not for opex purpose. So you should figure out a way ki how would you consume this excess cash, because this cash cannot go back to US as dividend, which is applicable in a subsidiary route. So you have to figure out a way how will you manage the excess cash that is generated month on month because of the transfer pricing. So that's broadly the considerations when you are trying to go or flip to US using a parallel structure. Now let's look at what is a EOR structure. So EOR structure, it's simple, like founders will go ahead and incorporate the US company as a direct shareholders. You can mirror a cap table from India to US. After mirroring the cap table, you should assign all the IP rights and other assets to the US company. So that's where the income tax would be applicable. Then you can raise money in HQ, whatever is needed. And you can find a EOR partner who can help you to build the India team compliantly. So you can look at companies like Rapid, who is very India focused and does things only on a compliance first approach. EOR offers you certain advantages, like you're lowering the operational cost. So there is no transfer pricing applicable, no corporate tax structure, is just a flat fee. You also have the advantage of setting up in-person, hybrid or remote team. You can give stock options. And most importantly, you free up a lot of your bandwidth in understanding the Indian laws, doing compliances, so there is zero time spent on all these things. So this allows you to free up a lot of your bandwidth for the core task, and on top of it you carry zero employee liability. This is a new model which is catching up really fast. A lot of companies are now preferring because of the advantages and EOR brings. Looking at the complexities and stuff. So that's about the EOR structure. So recapping, you have the three structures, both the corporate structure, parallel structure and EOR structure. Depending on what suits you best, you should go ahead and execute it that way. You should big time look at all the capital gains, income tax and stuff, because this could be hefty sum of money, especially depending on what stage your startup is, how much money you have raised or how much is your valuation and all. And this may not be a right time to probably flip the structure, because the cost taxes are very, very high. So you should budget for it, and that's like impacting your cash flow directly. But again, if you continue to delay, the taxes is only going to increase, because the valuation is also going to increase at a later point of time rather than decreasing it. So looking at all these aspects, you should take a call how you want to go about it. So that's it in today's video. I hope it gives you some strategies and insights as to how you should go about when you're trying to flip your company from India to US. Thanks a lot and take care.